You think you are getting richer just because the S&P 500 is hitting all-time highs, but the truth is, you are getting poorer every single day you spend chasing a lifestyle you cannot afford. If you are in your 20s or 30s right now, you are standing at a massive crossroads. You see the headlines about record-breaking stock market valuations, and you think the economy is booming. But for most of you, that wealth is just a number on a screen, while your actual purchasing power is melting away like ice in the summer. Before we dive into the data that will change how you look at money forever, I want to see who is actually serious about their future. Go ahead and comment your current age and the exact amount you are investing every single month right now. Are you doing $100 or $5,000? Let me know in the comments, because your community is your leverage, and seeing what others are doing is the first step to waking up. 1929, 1965, and 2000. Those years marked some of the highest stock market valuations in modern history, and today we are at higher levels than any of those periods. We all know that valuations are not a timing tool, but if we overlay the stock market history, we can see that extreme valuations have done a surprisingly good job at signaling major market peaks. In 1929, that valuation peak was followed by an 80% drop in the market as the Great Depression hit. In the 1960s, it was followed by a decade of stagnation, and in 2000, the dot-com bubble burst and wiped out trillions of dollars in market value. What makes today even more fascinating is that these record valuations are happening right in the middle of actual military conflicts. Usually when the world moves closer to war, investors become cautious. Today, it seems like we are seeing the opposite. It looks like resilience, but it actually means the downside will be way more painful when sentiment eventually changes. This valuation metric combines everything: PE ratio, price to book, and even the famous Buffett indicator. By almost every measure, U.S. stocks are historically expensive. Today, there is simply no denying that. So why aren't they crashing yet? It is because corporate America is printing money faster than any time in history. Over the last 15 years, corporate profits have more than tripled. This is one of the fastest profit expansions we have ever seen. From the mid-1990s through to 2010, profits only grew by 100%. Today, corporate earnings are trending higher, even with global tensions. So yes, it makes sense that big institutional investors are willing to pay higher prices for these resilient businesses. But there is a catch. As long as earnings rise, valuations can stay high. But if profits roll over, it will create a lot of pain. To get a clear picture of where we are heading, look at corporate profits as a percentage of GDP. Historically, this matters a lot because the only moments where profits saw a real drawdown were when they contracted as a percentage of GDP. Today, corporate profits account for roughly 12% of US GDP. This is one of the highest levels going back all the way to 1947. If this drops to the historical average of 6%, it would be the catalyst for a massive market crash. And the single most dangerous factor is the corporate tax rate. Starting in the 1950s, the government raised taxes from 38% to 50%, and profits fell from 10% of GDP to just 4%. Then, in the 1980s, they started cutting taxes down to 21% today. This policy shift is the secret sauce behind the record stock market. If taxes rise back to 35% to fix the massive budget deficit we are seeing, right now the stock market could face a 40% valuation reset. But the current administration wants to keep taxes low until at least 2028. This means the extreme valuations might stay much longer than people think. For you, the individual investor, this means you need to stop living for today and start mastering 5 specific habits. Habit number 1 is handling your first real income. Most people get a raise and immediately buy a new car or a nicer apartment. That is lifestyle inflation. You are just turning yourself into a high-income wage slave. You need to create a gap between your income and expenses and keep that gap growing. I know people making $200,000 a year who are broke because they have no gap. Habit number 2 is building a boring emergency fund. Life is going to throw trash at you. If you don't have 3 to 6 months of cash, you will be forced to sell your stocks at the worst possible time or use a credit card with 25% interest. Lenders love it when you are unprepared. Habit number 3 is how you treat debt. Stop normalizing it. High-interest debt is a cancer on your wealth. If you are paying for a lifestyle on a credit card, you are literally volunteering to be a servant to the bank. Be aggressive and kill that debt early. Habit number 4 is the most important. Stop waiting for the crash. I see people in my comments every day saying they are waiting for the big one to start investing. Meanwhile, the market goes up another 20% and they are still sitting on cash getting eaten by inflation. Time in the market beats timing the market every single time. You need to be buying consistently. Always be buying, whether the market is up or down. Habit number 5 is delayed gratification. In your 20s, you have the most valuable asset in the world, and that is time. If you spend all your money on travel and bars, now you are trading your freedom at 40 for a few nights of fun at 22. I am not saying don't have fun, but find a balance. Drive a 2006 Toyota Camry. Live in a minimalist apartment. Stop buying things you don't need to impress people you don't even like. Real freedom is being 35 years old and having a portfolio so big that you can tell your boss to leave you alone because you don't need the paycheck anymore. So where should you put your money? Right now, a massive chunk of capital is flowing into AI and energy infrastructure. When corporate profits are 12% of GDP, you have to ask where that money is being spent. It is going into the infrastructure for the next industrial revolution. Stocks in the nuclear power sector and base metal mining are seeing incredible growth. But for 90% of you, the best strategy is the boring one. Low-cost index funds like VOO or dividend growth funds like SHD, and always maximize your tax advantages with a Roth IRA. The real story of the market today is that corporate America is operating under the most favorable tax environment in history. As long as that stays true, the market pullbacks will be shallow. Don't get distracted by the noise on the news. Focus on the math, focus on your gap, focus on your discipline. The snowball is rolling down the hill, and it is your choice, whether you want to be in front of it or building it. Your future self is either going to thank you or hate you for what you do with your next paycheck. Let's talk about the reality of the math. If you start with $1,000 and you add $500 every month for 30 years at an 8% return, you end up with almost $750,000. But if you wait just 10 years to start, you end up with only $290,000. That 10-year delay cost you nearly $500,000. That is the cost of waiting for a crash that might never come. The system is designed to keep you working and spending. The only way to break the cycle is to own the system through stocks. Stop being a consumer and start being an owner. The reason big oil companies like Chevron and Exxon are sitting on piles of cash is because they know how to play the game. They buy the infrastructure and they control the flow of energy. You need to do the same with your personal finances, control your own flow of cash. Look at companies like Plains All-American Pipeline. They are cash cows because they own the toll booths of the energy world. You need to own the toll booths of the global economy through diversified ETFs. The market is at record levels because profits are at record levels. It is that simple. And while taxes are low, companies are going to keep reinvesting into things like AI and automation. This is the greatest wealth transfer in history. If you are not positioned, you are the one being transferred from. Don T let a $5 latte today rob you of a $5 million retirement. Build your discipline, build your wealth, keep your head down, and stay focused. Every single month, I put my money into the market regardless of what the headline says. I don't care if Brent crude is over $100. I don't care if the straits are closed. I care about my share count. I care about my dividend yield. I care about the long-term structural uptrend of human innovation. You are a part of that innovation, or you are just a fuel source for it. The next 10 years will define the next 50 years of your life. Stop watching from the sidelines. If you want the specific trades I am taking, and if you want to learn exactly when to scale in, you need to find a mentor. But even without a mentor, the simple path of DCA into VOEU is enough to make you a millionaire if you have the stomach for it. The market is going to be volatile. You are going to see 10% or 20% drops. Those are not risks. Those are opportunities for you to buy the future at a discount. Most people panic and sell at the bottom because they don't understand the macro picture. They don't understand that as long as the tax code favors corporations, the market has a floor. They don't understand that earnings growth is the ultimate driver of price. You are now part of the 1% who actually understands why the market is high and what could make it fall. Use that knowledge to stay calm, stay invested, and stay disciplined. I want to see everyone in this community winning. I want to take you guys with me to the top. Financial freedom is not a dream, it is a choice, and that choice starts with how you spend your next dollar. Choose the asset over the liability every single time. Thank you for watching, and thank you for being part of this journey. If you found value in this video, then you know what to do. Hit that subscribe button. Peace.